Hey everybody, Tim Albrecht here, and thank you for listening to the YFP podcast, where each week we strive to inspire and encourage you on your path towards achieving financial freedom. This week I had a chance to sit down with YFP co-founder, co-owner, and director of financial planning, Tim Baker, to talk through two I's that you might be overlooking as it relates to your financial plan, that being inflation and I bonds, more formally known as Series I savings bonds. During the interview, Tim and I discussed why inflation can sneak up on you and is an important yet often underestimated consideration for the financial plan, some strategies to combat inflation, and what I bonds are and how they are one tool to consider hedging against inflation. Now, before we jump into today's episode, now that we have flipped the calendar on 2022, it's time to think about tax season. I'm excited to share that YFP Tax can file taxes for an additional 125 pharmacist households this year. The team at YFP Tax isn't focused on just completing your tax return. Instead, they provide value, care, and attention to you and your taxes. Because YFP Tax works specifically with pharmacists, they are familiar with aspects of your financial plan that have an impact on your taxes. The YFP Tax filing waitlist is now open, and if you're interested in working with a team of highly trained tax professionals, I invite you to add your name to the waitlist by visiting yourfinancialpharmacist.com/tax. Again, that's yourfinancialpharmacist.com/tax. Tim Baker, Happy New Year.
Yeah, Happy New Year, Tim. Hopefully you had some good time off with the fam over the holiday.
We did, and really excited for 2022. We've got a lot of exciting content planned for the YFP community. And today we're going to be talking about inflation and I bonds. And, you know, I know that the words inflation and bonds don't really scream exciting topics, but, you know, we're going to have some fun with this episode. And I'm confident our listeners are going to take away something valuable that hopefully they can apply to their financial plan. And our approach for today's show is we're going to talk about inflation first, and then I bonds as one strategy to hedge against inflation. Now, inflation, Tim Baker, something we haven't really talked about in detail on the show, which I think is fitting because we're a few hundred episodes in. And, you know, if we think about inflation, one of the things I think about is that we often hear that term, we think about it, we know it's somewhere in the background, but it might not be front and center or something that's top of mind as it relates to our financial plan. And so we know it's real, but it can be hard to put our finger on it. Exactly what is inflation? What is the impact that it might be having to my financial plan? And that's something that I think hopefully folks will be thinking about, especially over the long run when we think about the impact that inflation can have. So Tim, kick us off. What is it, inflation, and why is that term getting so much attention right now?
Yeah, so I'm going to steal Investopedia's definition, and they define it as the inflation as the decline of purchasing power of a given currency over time. So I think like for a lot of people, myself included, you know, before kind of getting into financial services, I'm like, what is it? I kind of knew very high level what it means, but I didn't really connect the dots. You know, I just thought, okay, like prices go up. You know, I think to date myself, I think when I started driving, you know, gas was at like under $1, you know, whenever that was. So 89 cents. Maybe that's when my brother started driving, my older brother.
That's when we were in high school, Tim.
Yeah, yes. Yeah. So like, you think about where it's at now, and I think, you know, gas is very tightly controlled in a lot of ways because of one of those numbers that kind of hits us in the face every day when we're going to work. But yeah, so it really is reflected in the increase of the average price level of a basket of selected goods and services in the economy over like a period of time. And we typically represent inflation as a percentage. So like when we do planning, you know, we look at historical rates, you know, year over year. And most planners, I think, use a 3%, you know, inflation mark. But right now where inflation is, which is, you know, it's been reported, you know, 6.8%, you know, there towards the end of the year. That's not necessarily good enough. So, but over time, typically 3% is what we use as planners. And what it means is that our currency, you know, the dollar effectively buys less than it did in prior periods. And I'll talk about inflation when we typically talk about investments, because I'll say, you know, for a lot of people that are, you know, more conservative in nature or just don't really understand investments, they'll say like, Tim, do I have to? You know, do I have to invest? Like I don't like the swings in the market and like the news and, you know, all that kind of stuff. So, you know, I'd rather just not if I could. And again, this is the extreme example. And I'm like, yeah, you kind of have to, because if you've heard one of my webinars, I'll invoke my dad who's in his 70s. And, you know, we talk about back in his day, you know, a nickel would buy the whole candy store. Now it doesn't buy anything. And, you know, we also kind of illustrate the point of that, you know, that Starbucks coffee that costs, $4 in 2020, in 30 years, using historical rates of inflation of 3%, that same Starbucks latte is going to cost you $10 in 30 years. So, what we can't do is stuff our mattress, full of dollars and hope that we're going to have enough at the end of the rainbow there. We're not. And it's because of those little termites that are going to, inflation termites that are going to eat away at the purchasing power of your money. So that's really what's at stake here. And, typically the financial services world will say, invest. And that's typically what we want to do to kind of keep in front of inflation. But here, what we're going to talk about is more about, what these I bonds are and kind of follow that, inflation and I bonds discussion. So, the idea here is that inflation is a thing that, it's kind of like death and taxes, right? And typically it follows economic progress. Sometimes it comes when there's too much money in the system, which we've seen over the last couple of years of what the government is doing. So this can lead to an escalation of prices. So, it's important to understand, at least at a high level. And that's one of the reasons why we wanted to bring this up today.
Yeah. And I think it's something, the time is right, Tim, right? I've mentioned on the show before, I'm still that old guy that gets the Wall Street Journal at my house every day. And every day it's either front page.
Like the paper version?
The paper version.
Wow, that is old school. Do you shake your cane at the kids that run through your yard? I love it.
I don't know. There's it might be from playing Paperboy. Did you play that game growing up, Paperboy?
I did. Yeah, that was cool.
There's some feel goods. When I hear the car go by in the morning, I hear the paper hit the driveway, so yeah, but inflation is front page, and it has been for several months now. And I think we're getting practical here, which is what we need to, because I think inflation, and you mentioned kind of the concept of termites, is a really good example because, you might go to the grocery store and even in this time of period where we're seeing, 6+% for those of us that aren't that old yet, this is pretty big for us historically, right? We've heard our parents talk about, double digit inflation and so forth. But for us, this is, significant and perhaps something new that we're dealing with. But, even on $100, $200 purchase at the grocery store, you might not be like, oh, wow, that's having a big impact. But if we take a step back and extrapolate that across all of your expenses, right? Could be groceries, could be, households, could be goods, could be utilities, could be cars that are being purchased. The list goes on. And you're spending, X thousands of dollars per year. Obviously that has a big impact that we need to be thinking about. And if that continues to go on, we've got to have some strategies that can mitigate that over time. And so I think it's really important as we think about some strategies. We're going to talk about one of those today, which is the I bonds, more formally known as the Series I savings bonds. And just a reminder before we dig into this discussion, certainly this is not intended to be investment advice, right? We're going to be talking about one vehicle. I think the strategy of inflation and mitigating inflation across the financial plan over several decades, of course, goes well beyond just considering Series I savings bonds. So again, not investment advice, but I think one unique opportunity and tool. And a shout out, this question actually came originally from an individual that attended a YFP investing webinar in 2021. We then addressed it briefly on Ask a YFP CFP, which we publish weekly, episode 93. And the question at the time related to, is it okay to have a portion of my emergency fund in an electronic U.S. Treasury savings bond, specifically in reference to the I bond? And what was interesting was at the time that question came in, the I bond combined rate, which we'll talk about what that means, was 3.5%. And now, because of inflation and the discussion we just had, we're seeing that rate now north of 7%. So again, one vehicle, but something I think that's worth considering might be something of interest to many that are listening. So Tim, give us an overview of what I bonds are, and then we'll talk about some of the pros, cons, and potential role that this may play in the financial plan.
Yeah, just to address the point, to piggyback on, before I talk about the I bonds, just to piggyback on the idea of why is inflation outside of it going up, a lot? I think what's happened over the decade, is that, and I think people have seen this, but then now we're seeing it more tied to consumer goods. The average value of houses has risen by 58% since 2011, the last 10 years. The Dow Jones has been up 147%. An acre of farmland up 37%, but I think it doesn't really hit us in the face until it's we're at the grocery store or that type of thing. And I think that's why, outside of the huge increase, I think it's leading to discussions about double digit inflation and kind of returning. I looked up some numbers, back in the early 80s, again, kind of when I was born, the interest or the inflation percentage was 13.5%, and that was leading mortgages to go up as high as 17%. I think even higher than that. So think about that. Like I was kind of complaining when I bought my house in Baltimore that was like 4.5%. I'm like, oh man, this is so high, especially now it's like 3%. So, a lot of this is relative and we've seen, this has been cyclical. It was really high in the 70s and 80s. It was high, I think, in the 40s at one point. It was high like right before the Great Depression. And, that was kind of one of the causes there. So, yeah. And I think, to talk about like how to mitigate this which is we talk about the I bonds, the tried and true is always talking about like equities, like stocks, like investing in stocks, investing in real estate's another thing. So to kind of, preface that, and I would encourage everyone to kind of listen to the Ask YFP episode, because we kind of talk about even just setting it up and how that, how that experience was. It's really about going to the treasurydirect.gov and you can buy them directly from the government that way. And what we're talking about here, the Series I bond, not to be confused with the double E bonds. It's really, again, I think what I said in the episode is kind of eye-popping where those were when I bought mine, which I think was like 3.5%. And now, the inflation component is like 7.12%. So the way it works is you buy the I bond and every 6 months, the Treasury looks at the inflation rates and they basically adjust that inflation component. So when you buy an I bond, there's really two components. There's the fixed component, which is at 0%. And then the inflation component, which is at 7.12%, which I think holds until April of this year. And then those two things combined are your composite rate. And that's basically compounded semi-annually. So right now, for these first 6 months, it's going to be locked in at that 7.12, and they'll reassess it. And it could go up, it could go down. Sounds like it could go up based on the news and things like that. So it's really in the episode, I kind of talk about tips, like where it basically follows inflation. It's kind of the same thing. And for people who are on fixed incomes, retirees, or are looking for something safe, these are definitely something that you can look at. We talked about it in the context of emergency fund. There's tax advantages here. The big drawback to the I bond is the holding period. So basically, the reason that we were kind of not an advocate for using it for an emergency fund, especially as you're building it, is that you cannot touch the dollars that you put in there for a year. So obviously, that's not ideal for an emergency fund. But once you get beyond the year, you can touch it, but you're penalized. So I think there's like a 3-month penalty of the interest that's been accrued, and then you can get to it. And then after 5 years, you can essentially do what you want with it. But the rates are interesting because it's really been the highest that they've been since, I think, May of 2000. So again, if you're thinking like, man, I'm looking at my high yield savings account, which is paying 0.5%, or a 5-year CD is paying less than 1% or 1%, whatever they're at today. This is an interesting way. And again, I talked about it yesterday. Like, I'm going to keep it simple, like, investments, high yield savings account, not a lot of variation from that. But I think where everything is in terms of the state of rates and things like that, I think it's a viable way to go. Some of the things that, are interesting about I bonds, there's just kind of some quirky rules. So like, as an example, if Shay and I want to buy these bonds, we're really limited to $10,000 each per year. Now you might say like, well, that's quite a bit of money. And I would agree. But if you're looking at this as a major component of your, say your retirement portfolio or retirement paycheck, that might not necessarily be enough. But if you have children, you can also buy I bonds at the same rate per year for the kids that you have. And then the other thing that you can do, and Tim, this might be something that we dust off and talk about, is you can buy them for entities. So we might be able to buy them for, say the business entity. And even though that, we own the business entity and we have our own, in our own portfolio. So that's something that I think allows you to be a little bit flexible. And then the other thing is that the levels at which you can buy are basically set, but outside of like if you were to use a tax refund. So right now we're heading into tax season. And if you're thinking, this sounds really interesting, maybe I want to do this to kind of eke out a little bit more yield from what I'm doing in kind of my cash components of my wealth building, you can actually use the refunds that you get from the IRS to purchase, additional amounts of I bonds. So it's something that, is, again, it's tied to the consumer price index, which is, very much related to inflation, that the U.S. Treasury Department basically reviews and then adjusts the inflation component of the rate accordingly. So if you're out there and you're like, man, I do not like the rates that I'm currently getting in kind of my cash and cash-like investments, this is definitely something to potentially look at, given what you're looking at it for, your financial situation. Again, I wouldn't necessarily do this if you have no cash component, but I look at it as a very viable way to kind of hedge against the inflation. Because just to talk in broader concepts, Tim, if you have a savings vehicle and you're earning, 1% on that savings vehicle, which is very, generous right now, and inflation grows by 7%, which is kind of what it's been trending to the last couple of months, you're essentially 6% poorer. So you might feel richer because you're putting those dollars aside. And that's why a lot of people call inflation the worst tax, because it kind of goes back to that idea of like, it's the termites that eat away at your purchasing power. It's that hidden ninja, that hidden assassin that's just really beating you down in the background. So these are things that, especially, because of where it's trending, just to be cognizant of. And one of the things that we do, so you kind of talked about how powerful this can be. One of the things we do with clients, Tim, is go through the nest egg calculation of like, hey, you need $4 million to retire. And that's where a lot of people look at us like we have 4 million heads, right? Because it's a number that's in the future that's very large, that tangibly I can't really wrap my head around. So what we say is, and I'm going off just an example here, if you make $125,000 as a pharmacist and say you're 35 years old and you want to retire at age 65, that gives you 30 years left to work for the man, right? So you have 30 years of earning potential and you're going to retire at 65. So we're going to assume that your wage is going to increase, over time as well. And we'll say that for the purposes of this, we kind of do a wage replacement ratio of what you need to live off from 65 until basically the end of life. And that allows us to get to that number of 3-4 million in that range. But that wage replacement ratio, say of 125,000, if we discount that sum, we usually discount it by about 30%, and we're planning for that 70% is what we need to live in retirement. That's 87. So 70% of 125,000 is $87,500. But in 30 years, when you are 65, no longer 35, using historical rates of inflation, 3%, that paycheck is not 87,500. It's grown because of inflation. So now it's 212,000. So think about that. So right now, I'm saying if I were to retire right now at 35, I would need 87, and I'm making $125,000. I would need, if we discount it a little bit, because typically we don't plan for like saving for retirement while we're in retirement. Right now, I would need 87,500. So that's where, I kind of talk through, Tim, you would come to me and you would say, Tim, I need 87,500 for 2022. And then basically the next year, 87,500 for 2023, given some inflation. But if we don't retire and we wait until we're 65, that 87,500, you're going to be basically hand out and say, where is my retirement paycheck for 212,400 essentially? So if you think about it in those terms, you're like, holy geez, like 87,000 in 30 years is going to be 212,000. That is why methods to protect you against inflation are really important, because you really want to protect your purchasing power on your dollars, which means not standing on the sidelines. It means investing. It means thinking of things like I-bonds, et cetera. So I know very much tangential here, Tim, in terms of an stream of thought in terms of this, but that's what we're essentially talking about when we talk about inflation, and then kind of how I-bonds can keep pace with that.
Yeah, I'm glad you went there, Tim, because I think this is something, I'm sure you and the planning team see with clients. I've seen it over and over again when we do sessions with pharmacists on investing, right? We have them dust off that nest egg calculator. We punch in the numbers, they spit out a number, and like you can see that overwhelmed look.
Or crickets, like,
yeah,
what does that mean? Yeah.
And, I think one of the things that the planning team does an awesome job of is, when you're thinking 30 to 40 years out, like it can feel like fake fuzzy math. And I think it really has to be discounted back to what does this mean today? What does this mean today in terms of, here we're talking about combating inflation, but also what does this mean today in terms of my savings plan, and really trusting the math and, trusting the process in terms of where we're trying to go for the long term. But that's why when I say, hey, audience, how much do you think you're going to need to have to save for retirement? Inevitably, folks are underestimating what is the true need, right? Because they're not thinking about it in terms of inflation and the impact of what future dollars are going to be needed. They're thinking about it of, okay, I make $100,000 today. I'm going to retire in 30 years. And they're not thinking about what might be the impact of what they're going to need if that income continues to rise. And obviously the expenses rise with it accordingly. And, a separate conversation for a separate day. But I think one of the concerns that we need to be thinking about talking about in pharmacy is when I then go down that path in a presentation, have that discussion, people are like, man, is a pharmacist really going to be making $200,000 in 30 years, right? Whatever that would be. And obviously that gets to supply and demand and rules and all other types of things. But certainly we need to be thinking about what is the impact of this over many, many, many years over time. Tim, talk me off the ledge. Okay, so I'm looking at my Ally account, and a couple years ago, we would have been better off storing some cash in a high yield savings account, right? When they were, remind me, I think we were almost at 2% a couple years ago, weren't we?
I remember Ally, I think it was like 2.35%.
Yeah. So I'm looking at 0.5.
And I would twist my mustache every time, Tim, and I would get the email saying, hey, your Ally interest rate has gone up. And then when we just get those emails that like, your rate's going down because, rates have gone down, but they're kind of back on the rise. Yeah.
So I'm looking at 0.5. And at the time, obviously we're looking at a composite rate. Reminder, I-bonds includes both a fixed component, currently 0%, an inflation component, currently 7.12. So that combined rate of 7.12 clearly beats 0.5. But that was a very different scenario a couple years ago. If you look at what those rates were then, you would have been mathematically better off, stashing your money in an Ally account. So, in this period of time where folks might be feeling that pressure of inflation, I want to talk about this in the context of an emergency fund specifically. So let's say that, Tim, you personally, so this is not advice for anyone else, you personally, maybe you have a need of, $40,000 in an emergency fund, $30,000, whatever the number is. As you're kind of evaluating that, especially where you're seeing this discrepancy of 6.5% or so, like how are you thinking through, or questions you're asking yourself about, hey, what might I keep right here? It's liquid, it's accessible, I can easily get to it when I need it, versus something I might put in an I-bond, try to beat some of this inflation or keep pace with what it's going, knowing that there's these limitations. You talked about them in terms of, within a year, no bueno. Within 5 years, we got to pay, a few months penalty on the interest. So obviously we lose some liquidity and accessibility. Tell me more about how you'd be thinking through that.
So I value simplicity a lot. So I think for me, the numbers would have to really be, telling for me to like kind of change up my, pattern of how I do things. So if we take an example, say we shave off $10,000 of that $30,000 or $40,000 emergency fund, or say you have something that's going to come up, because the hard part about investing long term, I think, is fairly easy. It's when you start, investing in the medium term or even the short term, where it kind of gets funky. Because again, the market, if you look at the S&P 500, I think like the worst year over year return in the market is like down 37%. But then it's been up 40%, year over year. So when people say like, Tim, like, what should I do with this money? I'm like, just put it in a high yield. Like, don't even mess with it. If it's like 3 or 4 years, that's when you're like, okay, is there a portfolio you can build out where you're going to take some risk? That's a stock and bond portfolio that, you're taking some risk, but you're, kind of hedging against some bonds that can, eke out more return than like what a high yield or a CD can do. So, if we take this example and we say, okay, there's $10,000 there, whether it's for an emergency fund or something that's in the future, if it's a 0.5% that you're getting from a high yield, at the end of that year, you're going to have not 10,000, you're going to have $10,050, $51 because of some of the compounding period, $52. But if you were to do the same thing right now with the I-bond would be worth $10,360. So, now I'm thinking, I'm like, all right, do I want to do it for an extra $300? And, for me, I don't know. The answer might not be, great enough. Maybe if it's $100,000, which again, I'm not putting $100,000 myself into an I-bond, maybe that's a difference. So, the thing is like, okay, so then if you say a year out, I need this money, but then you take the haircut on the interest penalty, it's probably not worth it, right? But the further you go out, and that's the case with any investment, is typically the longer you hold it, the better it is. So I'm going to go back to my age old, saying, which it just depends. Again, if your emergency fund is not built, then I would say probably not. Get that level of cash, and then you can start looking at a deeper reserve, or for something like if you know that you have something out that's 2 years out that you're like, hey, we're going to save for an investment property or for a wedding or something like that, then this might be a good way to go, because if you invest it, there's a chance that you could have a negative return, which that is not here. This is backed by the full faith and credit of the U.S. And even if we go into a deflationary period where interest rates are negative, which that's not the case, it's still buoyed by, the composite. So, and even like past earnings that you've had at that, 7.12%. So it really depends, Tim. I think you have to figure out like the penalties that, how long you're going to hold it. For retirees, this might be a good component of like a, even like a bond ladder or things like that. So, people that know, hey, I'm 60 years old and I want to retire at 65. this might be a component where you are building out the first couple years of your retirement paycheck that it makes sense. So there's just a lot of different, ways to kind of slice the apple here. And I think it just depends on your situation. But I think, if you're out there and you're like, I'd rather do this with my emergency fund that I'm building right now, I would say pump your brakes, because again, don't want you to have to reach for the credit card if something comes up, to kind of cover that emergency. So again, if we're kind of trying to keep pace with inflation, this is something that kind of automatically does it for you, that the Treasury sets, but it's not going to get you. So, the caveat to all these conversations, Tim, is that, if you need 3 or 4 million when you retire, investing in I bonds is not going to do it, right? So you have to have a stock portfolio that will get you there. Now, if you're approaching retirement, a bond portfolio and a bond ladder or some type of SPIA or something like that will kind of, get you to where you have basic needs and can kind of, also participate in the market and get some return is going to be important as well. So it just really depends on where you're at, what you want to use it for, as is the case with everything. But if it's something more near term, or, if you want to kind of, because I would even argue that a bond portfolio compared to an I bond, you're probably going to, be better in a bond portfolio even right now. So things ebb and flow as well. So, it just really depends on the situation, but there's just a lot of factors to consider.
I think there's a lot of good stuff in there, Tim, though. And that was partly why I asked the question, because I think sometimes, I'm speaking here to my fellow hyper analytical pharmacy nerds that are looking at the percentages, but it's a good reminder. I think, sometimes we see a savings account, we're like, 0.7 versus 0.2, but do the math, right? I mean, if you're looking at 10,000, even in this, even if inflation keeps at this rate and we see the composite rate for 2 or 3 years, even if you max that out, like, what is the true net difference, right? And I'm not mitigating what a few $100s can mean. It's important, but let's not lose the big picture of what we're trying to go, or let's also make sure we're factoring in some of the downsides, considering, the liquidity, the time periods and things like that. So, hopefully hitting home that there's some value, there's a role, but I think a tendency when folks hear about something like this, myself included, is like, I'm logging on to US Treasury Direct, I'm buying right now, right? Take a step back, pump the brakes, look at the math, look at the bigger picture. And I think that's something, obviously, the planning team and the process, can really help with as well.
Yeah. And I think it's probably a good place for me to acknowledge, because sometimes I beat up on, people that will do things out of order a little bit, where I'm like, well, we have a bunch of credit card debt, but we have like $5,000 in like Robinhood, right? Kind of out of order. And I think sometimes that happens because of just curiosity. And this is kind of like what we did. We're like, I've always kind of said, hey, keep it simple, high yield, maybe CDs, that type of thing. And when this was brought forward, I obviously knew what I bonds were, but I was not necessarily paying attention to the rates, because they're typically very, very minimal because of where inflation has been. But we kind of went through that and experimented a little bit. And like, as we see kind of with people that do Robinhood and don't necessarily have the foundation set. So I don't think that's a bad thing, and again, like, I don't necessarily even have my I bonds on my balance sheet right now, because it's just kind of something that is in the background. But I do think it is I think a viable vehicle to consider, kind of depending where you're at. And again, at the end of the day, I'm always going to go back and say, work with your advisor and see if this is something that fits with you or, your spouse, and kind of get a sense of what that particular vehicle has, a place in your wealth building, in your portfolio.
Yeah. And I think, as we say often, Tim, and I know, we talk about student loans, we often say, hey, repayment plan decision, it's the math plus, right? It's the math plus all these other factors. And I think it's a good example of that here as well. I'm thinking about folks that might be hearing about this, thinking about their emergency fund, looking at inflation and like, man, I'd love to do that. But, does something like having your money liquid and accessible to you, does that provide some peace of mind? Like, don't undervalue that if that's important to you, and that idea that something might be tied up for a period of time. Is that worth it? Maybe yes, maybe no. And I think that's, again, a reminder of take a step back and look at how this can be considered as a part of the broader financial plan.
Yeah. And I think to that end, Tim, like, when I logged into my account again today, like, there's no like get my money out button, right? Because I'm still under the 1 year. And again, like, if that, like, thankfully, I have a pretty robust cash reserve, emergency fund, that if something does hit the fan, I can always tap into that. But if that's not the case, I'm like, that's just a number on a screen right now. So, and I'm assuming after a year that kind of unlocks, and then you kind of probably will talk about, penalties and things like that, but like, interest penalties. But there is something very satisfying about, okay, like, if there is, and again, like, I'll harken back to the beginning of the pandemic, when it was a very nice reminder, if I can say this without sounding like a jerk, the pandemic was a reminder that, when the markets and it seemed like everything was falling. It's why we have the emergency fund, right? Because the emergency fund it's just not fun to, for me, it's fun to like when we dip into it to like replenish it. I'm kind of a nerd there. So like if it's below the level, I'm like, all right, I want to make sure that we, pay attention to this. So it's back to its regular level. But when you're building it, especially from scratch, it kind of just stinks. Like it's good to make progress, but you kind of want to get to steps 5 and 6 and 7, but it's kind of following that, let's do 1, 2, and 3 first. So this is where I think you can get in trouble because you don't keep it simple. You do a little bit too much than what you need to do and you can be burned by it. But, I think sometimes we need those reminders to say like, okay, the emergency fund at the end of the day is not really to make you money. It's to be there in case something happens. So, but we try to, put it in places that we can maximize the value because again, year over year, that 20,000, 30,000, 40,000, whatever it is, that money that's sitting there is going to buy you less in the future. So that's another thing to consider as you're looking at your cash level. So
great stuff, Tim. I'm going to make sure in the show notes we link to a few things. One, the Ask YFP CFP episode where we talked about this as well. That was episode 93 of Ask YFP CFP. We'll link to the treasurydirect.gov website. Folks, lots of great information on there about the Series I savings bonds, rates, terms, tax considerations, and so forth. And then another thing I'm going to link to is Michael Kitces has a blog called Nerd's Eye View, and he had a blog out in December 8, 2021, Series I savings bonds, some of the end of year consideration strategies. I thought there's a lot of good information in there as well. We'll link to that in the show notes. And for folks that are hearing this and wondering, hey, how might this fit into the financial plan as well as other things that you're working through, whether that be debt management, whether that be saving and investing for the future, insurance considerations, estate planning, tax, and so forth. The team at YFP Planning would love to have an opportunity to talk with you further to determine if our services are a good fit for your financial planning needs. You can learn more at yfpplanning.com. Thanks again for joining. Have a great rest of your day. As we conclude this week's podcast, an important reminder that the content on this show is provided to you for informational purposes only and is not intended to provide and should not be relied on for investment or any other advice. Information in the podcast and corresponding material should not be construed as a solicitation or offer to buy or sell any investment or related financial products. We urge listeners to consult with a financial advisor with respect to any investment. Furthermore, the information contained in our archived newsletters, blog posts, and podcasts is not updated and may not be accurate at the time you listen to it on the podcast. Opinions and analyses expressed herein are solely those of your financial pharmacist unless otherwise noted and constitute judgments as of the dates published. Such information may contain forward-looking statements which are not intended to be guarantees of future events. Actual results could differ materially from those anticipated in the forward-looking statements. For more information, please visit yourfinancialpharmacist.com/disclaimer. Thank you again for your support of the Your Financial Pharmacist podcast. Have a great rest of your week.